Great. Well, to discuss this issue of whether the world is getting safer or riskier because of fintech, we have three excellent panelists. First, on the far end is Rory Eakin, who is Chief Operating Officer and founder of Circle Up, which is a equity crowdsourcing marketplace. Next to him is Gad Goldstein, who is Executive Managing Director of K2 Intelligence and founder and Chief Executive of K2G Global AstraZeneca and head of MedImmune, so lots of different hats there. And then next to me is John Stein, who is founder and chief executive of Betterment, I guess, robo-advisor in some sense for managing people's money. So I wanted to start with Rory. Crowdfunding is one of the things that definitely has been a hot topic because of because of technological innovation that has seemed to fit some of those models we talked about earlier of bringing more people in, new sources of capital and so forth. And yet, the SEC, which was supposed to bring in regulations to allow equity crowdfunding, make it much easier under parts of the Jobs Act several years ago, seems to have been too afraid to, or whatever, to come up with rules. So it seems to be that they're worried about the risks. I mean, how worried should we be? Should we expect the SEC to come up with some rules to allow us to crowd?
We should expect them to come up with some rules. We expect them to, at some point. Fundamentally what we're seeing with Circle Up is an online marketplace, opening access to capital for the 38 million entrepreneurs or small businesses across the US, much the same way online has revolutionized retailing in the country and transport and hotel industries. We believe financial services will benefit from the lower costs, the transparency, and the open marketplace overall.
And yet, I guess a concern all the way back to the 1933, 34 Acts and so forth has been this sense that most of the public are idiots and that therefore you need to provide all sorts of regulatory protection to stop them being ripped off by people pumping and dumping and all sorts of things.
So the Jobs Act did update regulation from what had been the 33 and 34 Act, over 80 years old. Obviously, the world is a very different place. And so what we believe is having an online marketplace improves transparency and visibility for things like fraud detection and including the risk of securities overall, and will benefit for regulators, for investors, and certainly for lower cost of access to capital for entrepreneurs across the country. So today, we're operating with accredited investors, given where the regulation is today. And I'm actually of the view that delay in implementing and opening up for all Americans isn't necessarily a bad thing. Having the evolution and the innovation work within the accredited market early on to identify the risks and the spectrum of returns and the different platforms in the ecosystem may be the right way for the SEC to then roll it out to a wider audience.
But do you think there's anything to the worry that a lot of people will go on these sites and sell dodgy company stock to people who are a bit gullible?
Well, not if they're regulated by FINRA and the SEC, like Circle Up is. You see pretty quick, rapid response for platforms that don't go through a broker-dealer process, as Circle Up has, and don't provide the protective measures of due diligence on the investors, providing suitability analysis, the steps that are tried and true within the financial services industry overall. But fundamentally, we're much more open and publicly scrutinized than many other private placements, which is what we do, than in the offline world. So it's an added degree of scrutiny, not only from regulators, but also from the public at large.
Now, John, you want to come in on this?
I'll add to it. You said something maybe controversial, which is that that regulation is there to protect the idiots in a sense. And maybe sometimes it's intended that way, but the markets that we operate in, financial services, don't exist without regulation. The idea that there's a market before you have laws is it doesn't make any sense. There's a market because of the laws that govern that market. And those laws actually make things more efficient. And sometimes the law leads innovation, and sometimes technology and the industry leads where the law needs to go. I think maybe an example of innovation that's powering a lot of our business today at Betterment is ETFs. Many great people in the industry came up with this structure. There are questions, ongoing about it, but it's here to stay. It continues to get better year after year, and the industry is pushing that change, and the law is accommodating it.
But let me take you back to your early days when you were starting out with Betterment. I mean, did you think a lot about regulation? Did you think you could be like Uber and maybe just do whatever you wanted to do and force the regulators to change?
So I think it's a great question. I love to go back to that. I think there's a couple of common misconceptions about the space that we operate in, which is commonly called robo-advisory. One is that all these firms are kind of the same, and there's a few of them that look alike, and so they must be the same. Another is that we're competing with advisors. And really what you're asking about is the first. And we're not the same as the others. As the first mover, and today the largest robo-advisor, we are fundamentally different from all the others. The reason that we're the largest, the reason that we're the fastest growing is because we've built new rails for financial services. We are a custodian. We are actually managing people's assets.
But was that how you saw the landscape when you started?
So we started to be an advisor, to align ourselves with our customers. We wanted to be a fiduciary. That was an important part of our model because typically 0.2% of the US population has access to fiduciary advice. That's basically nobody. Maybe half of this room, but almost nobody outside of this room. And today, because of Betterment, fiduciary advice is accessible to everyone. And that's a big change. That's a fundamental shift, and advice is at our core. But to really change things, to really provide better advice, we had to do something that no other firm in our space has done, which is actually build the back end, build the custody, build new rails on which to run this better advice so that we can deliver it better, with better experience, better service,
but we had this discussion earlier about whether the model of regulatory change is going to be that regulation would lead innovation, or whether innovation would disrupt and then regulation would have to adjust. So when you're sitting there thinking, I want to extend fiduciary advice to the masses, did you say, well, let me understand and study the fiduciary regulatory environment and optimize for that? Or did you say, this is what people need, I'm just going to do it and the regulator can...
I bought a library. I literally bought 40 books on trust and estates and derivatives regulation and investment law, and started, just trying to read and figure out what we would be. I wasn't sure if we would be a mutual fund or a bank or this or that. Ideally, I wanted to not be regulated. I just wanted to do right by our customer and build the services they wanted. The laws are written well in this country such that you can't just manage money and not be a regulated entity. You have to fall into one of those buckets. And the right one for us was a fiduciary. But it took a lot of time, a lot of research to build that out. We developed a relationship early on. It took 2 years to get our approvals from FINRA and the SEC before we could go live. It was a significant investment of our time. We continue to be examined by FINRA and the SEC every year. And we continue to have great relationships.
Briefly, Rory, you want to come
Well, I think what you're raising is the stakes are higher in fintech. You are watched, and people recognize that the regulatory environment is much greater in some respects than some of the other areas where you see disruption out of Silicon Valley. That forces a model of engagement and deep preparation. Our story is very similar, of looking at the existing rules and building a model that was compliant within the old regulatory regime prior to the Jobs Act even. We've been able to benefit from some of the changes since the Jobs Act has come into play in some ways.
But clearly, you would be, if you hadn't got to deal with this regulatory library, you would presumably be doing things different and things that you think would be better for your customer. What would they be?
Well, we certainly look at the wider market across the board of all investors in the U.S. and all companies in the U.S. So today, we have a deep obligation to provide both suitability, and I mentioned earlier, and AML restrictions around the U.S. For the investor side. So there.
You just say what AML is.
Sorry, anti-money laundering steps on both sides of the marketplace. There are. I'm not dismissing the amount of steps involved to run an online broker-dealer in a compliant manner, but we've found that it also builds a nice moat around the business. It's not easy to get the technology, the risk, and the compliance right, which are the three founding stools, we think, of our business model that make it a lot harder for a new entrant to come in.
John, briefly before we go to Gad, I mean, what would you be doing better if you had been able to design the regulation of your choice at this point?
Oh boy. So there's just so much. There's so many different regulatory regimes. There's banks and brokers and all these things. We ultimately want to be the answer to the question, what should I do with my money, for everyone. We want to manage all your money. And we can already do that better than most banks can. We can already do that better than investing firms can. But to do payments, to do all these other things, there's additional regulation around that. We just want to make it all as seamless as possible so that our customers don't have to think about regulatory structures. These are all, the idea that my daughter, who's 1 year old today, when she is graduating from college 20 plus years from now, we'll have to think about, should I open an IRA or a 529, or should I put more money in my Roth 401k? It's just crazy. She's never going to have to worry about that kind of stuff. All these sort of regulatory abstractions are going to be managed better by technology, and that's the world that we're building.
Rory. One just last point on this. Where we think this is going is, you mentioned the Securities Act 33 and 34, which regulate, in particular, public and private markets. In a digital age, we think we can get better, more wholesome, real-time data about private companies than you even see in public markets. So when companies are raising capital on Circle Up, you can see sales reviews of their products, management reviews of the management team, real-time sales data, completely automated and online in a digital environment much more efficiently than, for example, looking at 10Ks and Qs that can be 90, 180 days old on public companies. That's what we see the future. It's 30 million small businesses being able to raise capital much more efficiently than the 4,000 public companies in the US.
Again, I want to talk about cyber risk, which is obviously a concern in every industry, from sort of film stars to adulterers and so forth, which may be a highly correlated group, actually. But how does finance and the sort of changes going on there, how does that compare with with other industries in terms of the risk exposure and the extent that technological innovation may open up doors to sort of privacy theft or other worse kinds of risk?
Well, the financial industry is going to continue to be in the focus of cyber attackers, both criminal organizations and state. And this is because the finance industry is both a monetization opportunity and a critical infrastructure. And when we talk about this, we have to remember that there are two different aspects of this industry. We see hundreds, maybe thousands of people wake up every morning when you look into the dark net, what is called, or the black market. The only thing they have in mind is how to disrupt the fintech that is disrupting the regular finance or the old finance industry. So there is a disruption and destruction to the disruption in some way. Now, the fintech industry, I think, is creating more, at the end of the day, creating more vulnerabilities than closing ones. It's about opening, it's about connectivity, it's about sharing. In addition, it's a startup industry. And most of the startups are thinking about how to get to market with their product and less about regulation and security. We are trying to assist some of them in security aspects, understanding the landscape and so forth, but most of them won't do it in the early stages. And I think the result of what we're seeing is that just safeguarding your money, the old business model of a bank, is going to become again a very, very challenging task. And on a more global level, we are going to see conflicts between different countries that will create restrictions on the freedom of information. I'm sure most of you are aware of the free harbor ruling that was in Europe 2 weeks ago. And this is an indication of how countries are going to restrict the flow of information. Some even speak about a Leviathan scenario, the Leviathan of hopes, where everybody gives its freedom to a state that controls. So I think the fintech industry relies on that connectivity, and restrictions are going to harm it more than banks, for example, who are able to have servers in Europe and in the US, have big legal departments who can deal with it, can create protocols, different protocols for working in Europe and in the US. So all in all, I think the challenge is going to be dramatically bigger than what we see today.
And what do you see? Where do you see as the sort of most vulnerable points in the financial system?
Well, as I said, we have to look on two different aspects. On your personal money, there are many ways to try and steal it from your account or use different fraud techniques. And the people in this area of the dark net are very innovative about the ways how to go about it. When you look at state level, when a state would like to attack the financial system, it is possible. It's the same like the electricity or the water, any other critical infrastructure. And this
Have there been examples of the state trying to do that?
Well, I guess I would guess that most advanced states with cyber capabilities are looking, first of all, to defend themselves from this. This is a fact, but also looking on the possibilities of attack if they are attacked. And we will need some sort of a regulation on the global level, some arms control. And I would say even that the day is called when the valley meets the street. I would suggest that the valley would meet the hill before it meets the street, because without the intervention of countries and regulation on the global level, we won't be able to have this industry innovation.
So would you advise people to keep a bit of gold under their bed or something, just in case the system gets wiped out by China or something?
I don't know if gold is the best option. Maybe diamonds.
Diamonds. I mean, Rory, how much have you had to think about cybersecurity in your work as you've...
It's integral to what we do. So what I would say in response is the interests are aligned because we don't have the 200-year track record to fall back upon. We need to protect the integrity of our customers' information, of the assets within the business, and invest quite significantly on our side in ensuring that security and integrity because of the vulnerabilities to the system overall, but because of also we're building our brand as we speak.
And I mean, John, not having the legacy systems that banks have, and which many people would regard as the established players in your industry, the legacy systems are a big source of vulnerability and additional complexity. Have you been able to design systems that you feel are significantly different in their security from?
I maybe have a different view on this topic, that in some ways, technology and the transparency that often goes hand in hand with it actually serve to build a more secure world. I believe that things, and I'm not an expert, and I'm not going to talk about it at length, but things like blockchain, more public records of things, actually help to increase security, making fraud and theft virtually impossible. And if you talk, you said, would you stick a little gold under your mattress? And everyone laughed. And of course, that's a silly thing to do because that's the most vulnerable asset. Anyone can break into your house and get that. Banks offer some more abstraction, some more security because things become more digital. And as things become increasingly digital, they become more secure as long as we have this transparency. And transparency is a principle of ours. If you think about all the big scams in history, it's all due to lack of transparency. It's because people didn't know what they were investing in, or they didn't know what they were getting. The reason our securities market works is because of the transparency that corporations have to disclose to their shareholders, the kinds of information that they have to disclose. The more disclosure there is, the more transparency there is, the more secure our financial system will be.
Great. Well, let's take some questions from the audience. Who would like to kick us off on this? Yeah, right in the front here. There's a microphone that's going to come to you, and then there's a lady in the middle after that. And please say who you are.
Hi, Rajiv Shah from Deloitte Consulting. Interested in this question of advice. Clearly, there has been a lot of trust issues in this advice-related industry. But from your point of view, what was the, if you will, the pivotal or tipping point technology that helped you or helped this industry, which wasn't available 5 years ago? And notwithstanding ETFs and so on, which clearly made it easier, right?
Right. I'll take this to start, and then let the other panelists also address it if they want. But we see three major trends that have driven us to the opportunity today for advice. One of those is the reduction in transaction costs, starting with the deregulation of commissions back in the 70s. Today, it's almost free to trade. And so if you were to build an investment management company, you'd build it fundamentally differently than if you'd built it 5 or 10 years ago. Another is the low cost of diversification. It's essentially free to diversify a portfolio today, thanks to ETFs. And so if you were to build an investment management company, you wouldn't build it around high margin asset management anymore. And the third is the shift toward defined contribution plans. Almost everyone today is responsible for their own retirement. It's something we all have to think about. And it goes beyond this room to everyone else who doesn't have financial advice. They're also responsible for their own retirements. And we've created this system in a crazy way without advice for all these people. We didn't tell them how much to save. We didn't tell them, is the 401k match enough? Should you max it out? Should you more than max it out? So 83% of plan participants say they want more advice about their retirement, but only 0.2% of Americans have access to a fiduciary advisor. So it's into this huge gap that's been left by our retirement system and by the shifts in lower costs that we step to be able to deliver advice as the core proposition.
So our market is private placements. It's historically a very fragmented, isolated market. As a private investor, you're desperate for information about market comps, evaluating a company in the context of a much wider market. So, fundamentally, the first advantage for us is providing an open online platform where if I'm comparing company A, I can look at 100 other companies all in one setting and evaluate and screen them, much like you would be doing at a Bloomberg terminal with public companies. But the second big innovation that we benefit from is the advance of APIs. So we're able to triangulate data provided by an individual issuer in almost real time. So now if they say, we pull in background checks, we pull in data on the sales performance of the companies, we're able to look at lots of different data sets and put it in front of investors. So it fundamentally improves the experience of an offline world by rather than just relying one-on-one on what the issuer is saying. You've got market context and you've got third-party data.
Okay, we had it in the middle there.
Here we go. Hi, Diane Garnick, CFA Institute Research Foundation. So John, you mentioned some comments that really hit home with me. You said that you spent 2 years investigating. You effectively became a compliance scholar before launching. And everybody on the panel talked about the importance of the consumer. So my question is, have the regulators, 2 years in a startup world really is the lifetime of a company. That's not what you need pre-launch. So have the regulators gone so far in protecting the consumers that we're actually unable to give them the help that they need? And if you agree that that is the case, what advice do you have for regulators in this complex industry?
My own view of the question, it's a great question. It's something that we talk a lot about, it wouldn't surprise you, is that the regulators we're talking about people. And we're talking about a lot of intelligent people, and we're talking about some baggage and some sort of legacy code, if you will. And it's hard to innovate on that code. It's just very difficult to update things. And I look at government as kind of the final frontier of technology innovation. I think the most interesting things in technology right now are happening in financial services, education, and healthcare. I think those are the three most exciting industries where technology has the biggest impact in the next 10 years. But 20 years from now, I think it's government. I think it's going to take time, but there's so much that coding practices and processes can bring to more transparent and faster iterating and better governance. And that'll come in our lifetimes, but it's going to take a little while to get there. In our specific case, the people that we've worked with at all the agencies have been lovely, have been supportive. They've invited us to Washington to meet.
So they're clearly a terrible burden. If you're sucking up to them that much, it must be. Rory, how nice are the SEC?
I echo and agree. I mean, it's the old adage, you don't get fired for hiring IBM. In a lot of cases, if you've known it and seen it and regulated it for 20 years, it makes it easier to be comfortable with it. But we're engaged in a long-term dialogue and process of how our tools can help make their jobs easier. The record keeping, the transparency of an online platform is superior to an offline world. We have logs on all of the statements made by issuers. So if you're worried about fraud, well, isn't it great to have a digital record of every meeting between the company and investor, for example? That's a process.
Yeah.
I think we're going to see much more regulation on the cyber side, both on the international level and the national level. So maybe in the future it will take 4 years to before launching, and because we won't have any other choice.
A question down the front here. We'll our last question. Is there a microphone? Yeah, here we go.
Hi, I'm Patrick Williams with Veta. A question mainly probably for John, but you mentioned a couple of times that only 2% of the entire country have their assets managed by people with fiduciary responsibility. So obviously, clearly the wirehouses are not part of that entire system. And the majority of people that I know, or Morgan Stanley have told me in the past, that 80% of the next generation of wealth inheritors take their money out of the particular wirehouse that it's in. But my understanding is the vast majority of that money just goes down the street to another wirehouse. So how are you going to combat that?
I started out by saying that I think there's maybe a common misconception that we somehow compete with advisors. And we actually partner with advisors. We have advisors on our platform. We have a Betterment institutional product that they can use. They can white label it. It's their own brand. And they can use our technology to automate all their back office and provide advice on top of that. So if you're the type of person, if you've got $10 million even or more, and you want that advice about estate planning or inheritance or these kinds of things, you can still benefit from all the technology that we're bringing to bear to better manage your money and get that human interaction in addition. I don't think that's going away. I think that will remain. What we're bringing is for everybody else who doesn't have access to that today, we're providing advice. So it's zero advice or betterment. It's not human advice or betterment.
So to wrap up, I want to ask each of you to pick up on Diane's question. If you had to give if there's one improvement in regulation that you think would make the system work in a way that was both better and safer, what would be the one regulatory change you'd like to see? I'll just start with you, Gad.
I think you will need regulation, as I said before, both in the international level, controlling the arms race, and inside the country, you would have to have a stronger control on everything that is critical infrastructure, and the finance industry is part of this.
And the sort of regulation you would want that would create that control.
It's a lot. You have to share more intelligence between the entities. It has to be more managed by the state in order to be able to defend against outside attacks. So it's a whole system. It's not just one.
So the Patriot Act and the Know Your Customer stuff will seem like a tea party by the time this is all.
Way.
Yeah. Rory.
So Private securities have what's known as intent to hold. You have to hold securities for a period of time. We are a believer in markets and price discovery. So I would shorten the length that investors need to hold a private security and loosen the accreditation process. So there's an idea around means testing, whether an investor is accredited or not.
Last word to you, John.
I had a client back in my consulting days that defrauded investors from a lot of money, and we discovered the fraud. We sought to help the regulators assess the damage and then pay back the shareholders that had been defrauded. And it was so difficult to track down who had actually owned the shares and at what times. It was an incredible mess. And it seemed crazy to me that people could get away with this kind of stuff and still do today, because these laws haven't really fundamentally changed. And if we would just be more transparent about our data, the SEC with full transparency could easily spot any insider trading, any fraud, any mismanagement that was going on instantly. And that's, I think, the future that we're headed toward.
Great. Well, thank you very much for a very stimulating panel.
Thank you.
Thank you.